Welcome to Debt-Free Living in 2018. We're going to start off with what credit is. Anytime a bank, finance company, or business lends you money and you agree to pay it back at a later date, you're using credit. In most cases, there is a charge for borrowing the money, either in the form of fees or interest, or both. Now, credit affects your ability to borrow and conduct transactions. And your credit score is a key factor in determining your borrowing capacity and the cost of borrowing those funds. In general, a higher credit score rating will mean greater access to capital and lower interest rates. Your credit score can also affect the cost of insurance and the need for security deposits. A lender uses a credit score as a simple way to assess your risk. Identity fraud hits new victims every 2 seconds, so it's very important to pull your credit report at annualcreditreport.com or by dialing 877-322-8228. You want to check your credit report at least once a year, make sure that your personal data is reporting accurately, and if necessary, enroll in some type of credit monitoring. And always be careful with your information. Now again, you want to get your credit report at annualcreditreport.com. That is the only site that is backed by the FTC. Now I'm going to discuss what's in your credit report. When you pull your report at annualcreditreport.com, there are going to be 5 different information zones that you're looking for. The first is personal information, and again, that speaks for itself. Your name, address, social security number, date of birth, and previous employment or current employment. The next section is credit scoring results and summary. The easiest way to explain this section is if you've ever applied for credit and happened to have been denied, the letter that you get in the mail will explain the reasons why and have a number coded next to it. So that's what you would see in that section. The next section is trade lines and any derogatory accounts, or any accounts that you have open in your name, whether you've co-signed for someone or you've opened them on your own. The fourth section is inquiries. Anytime you give your social security number to apply for something, you would find it in this section. And then the last is public records. Anything that's court-related, bankruptcies, alimony, child support, judgments, or liens, you will find in this section. Now, as you can see on the screen, this is an example of what the credit report account section would look like. It'll let you know how many accounts you have open, whether it's revolving, installment, or a mortgage, if it's delinquent, etc. So again, it's very important to pull your credit report so that you know the information is reporting accurately. Now I'm going to discuss the 5 factors that make up your FICO score. And as you can see, the first and very large factor is payment history. 35% of what makes up your FICO score is your payment history. That's why it's extremely important to pay your bills on time every month. The next section is the amounts that you owe. 30% is what you have available. So if you have credit cards and they're all, say, $1,000 limit, and each one of them you owe $950, that's derogatory for your score. You want to keep your balances low, well below 30% of what your limit is. The next is length of credit history, and that's 15%. How long have you had these accounts open? The longer you keep the accounts open and active, the better for your credit. The next section is new credit. So how many times have you applied for credit in the past few months or the past year? That makes up 10% of your score. And lastly, the last 10% is the types of credit in use. You want to have a healthy mix of credit, such as revolving and installment. Revolving credit would be credit cards or store cards, stuff that you constantly use and pay. And installments would be student loans, car loans, or even your mortgage. You pay every month a certain amount until it's completely paid off. Now, this is an example. This is just for you to get an idea of how certain items will affect your credit score. So as you can see, this example is 780. This is what their credit score was. So if you were to max out your credit card, it would drop anywhere from 735 to 755. If you happen to be 30 days late on your mortgage, from 670 to 690. If you were to settle on credit card debt, anywhere from 655 to 675. If you had a foreclosure, anywhere from 620 to 640. And if you were to file for bankruptcy, that's the largest drop there is, it could be anywhere from 540 to 560. So again, it's important to pay attention to these things. Pay your bills on time, don't file for bankruptcy unless it's absolutely necessary, and make sure that you're on top of your FICO score. Now, how long can items stay on your credit report? A credit reporting company can report most accurate negative information for up to 7 years, bankruptcy information for up to 10 years. Chapter 13 is reported for 7, Chapter 7 reported for 10, and that's from the date of discharge. Information about a lawsuit or an unpaid judgment against you can be reported for 7 years or until the statute of limitations runs out, whichever is longer. Also remember that employers can get a copy of an employee's or prospective employee's credit report, but only if they agree to that by written consent. Make sure your credit report is accurate. Now, when it comes to dealing with credit problems, we hear it all the time. Credit problems, no problem. We can remove bankruptcies, judgments, liens, and bad loans from your credit file forever, whether they're yours or not. There is no quick fix for credit worthiness. You can improve your credit report legitimately, but it takes time, a conscious effort, and sticking to a plan. Again, when it comes to dealing credit problems, first things first. Pull your report for free from all 3 bureaus at annualcreditreport.com. Tell the credit reporting company in writing what information you think is inaccurate. You can find sample letters online at the FTC. Identify each item on your report that you're going to dispute, state the facts and reasons that you're disputing the information, and ask that it be removed or corrected. Credit reporting companies must investigate the items you question within 30 days. If an investigation doesn't resolve your dispute with the credit reporting company, you can ask that a statement of the dispute be included in your file and in future reports. So you're disputing these items. Obviously, you're looking to rebuild your credit if it's not perfect. There are a few things that you can do. And the first is sometimes just let time heal the wounds. As negative information becomes older, it becomes less important, so it has less of an impact on your 3-digit credit score. Another thing to do would be to fix the mistakes. This is why I stress the importance of pulling your report and verifying and making sure that the information is accurate. You may have accounts on there that don't belong to you, they may have incorrect balances, or there may be duplicate accounts. And if it's a negative item, you do not want it to be a duplicate. And lastly, build positive new credit references. If you don't have a credit card, perhaps you should try it and get a secured card. And that's where you place a security deposit with the lender, and that deposit that you place will be your credit limit. Again, it's a credit card, so you want to make sure and use it responsibly, keep it below 30%, and pay it off every month. Use credit very carefully. Always pay your bills in full and on time. And carrying balances and paying interest is not necessary for rebuilding credit. In fact, if you can pay your bills in full and on time every month, that will help improve your credit as well. Now I'm going to discuss predatory lending. If you're trying to avoid debt, stay clear of predatory lenders and beware of scams such as phishing scams, where they try and get your information either via email or phone, getting your financial information, credit card information, or bank information. Look out for military loans offering instant approval. Watch out for housing ads promising military discounts or regular discounts that are just too good to be true. Usually, if it's too good to be true, then it is. When it comes to cars, low price vehicles posted in the classified ads to grab your attention and then pull you in, they charge you super high interest rate or the car is actually a limit. So you want to be very, very careful. Watch out for title loans, prepaid cards, payday loans, which cost you up in 400% interest. You want to be careful from predatory lending. And you wouldn't have to worry about predatory lending if you were making sure your credit is where it's supposed to be. Another way to deal with credit problems is to get help. There's no shame in seeking help. You can do credit counseling. There are reputable organizations that can advise you on how to manage your money and debts, help you develop a budget, and offer free educational materials and workshops. There are debt management plans. This is where creditors may agree to lower your interest rates or waive certain fees while you make regular, timely payments through a credit counseling agency. There's also debt settlement, which is negotiating with creditors to allow you to pay a settlement in order to resolve your debt. But there's a potential for negative impact on your credit and other serious consequences. And lastly, always lastly, as a last resort, there's personal bankruptcy. And this may eliminate completely or restructure debt. But again, consequences are long-lasting and far-reaching. Remember how much your score can drop by filing for bankruptcy. So I've been talking a lot about credit, and there are some advantages to using credit. So credit can be a good tool for emergency situations, just in case you don't have enough savings, you may be able to use that instead. Using a credit card is a convenient way to pay for things without having to carry large amounts of cash. A credit card is something easily canceled. If you lose cash, it's gone forever. Some credit card companies may offer protection for your purchases, such as bonuses and rewards, etc. And then you want to make sure, again, that you can get those bonuses and awards by using your card and paying on time. Now, a few disadvantages of using credit. It costs you money. Again, remember those fees and interest that I mentioned in the very beginning. Credit can tempt you to spend more. I always like to tell people it's not your money. Remember, you have to pay it back. When you make a purchase using credit, you commit to using future income to repay the loan. And then some lenders will report all missed credit payments to the credit bureaus. And again, that could negatively affect your score. Now I'm going to discuss the risks of unmanaged debt. This whole webinar, this whole presentation is about debt-free living. And there are some risks for unmanaged debt. You have higher interest rates, you get higher insurance premiums, you can be denied credit altogether, denied rental of an apartment because they check credit for that as well, denied jobs, there's stress and illness, and if you are in the military, your military security clearance can be denied. So these are things that you don't want to have to deal with. A few of your credit responsibilities would include borrowing only what you can repay. Remember, you know how much you make, you know the income you have coming in. It has to be something comfortable for you to afford. Always pay your debts promptly. 35% of what makes up your score is on-time payment history. If for some reason you cannot make your payment, notify your creditor. They're more willing to work with you when you contact them than if they have to come looking for you. And if you lose your card, report lost or stolen cards promptly. You don't want to be held liable for purchases or charges made on that account. Now I'm going to give you a few tips for how to use credit wisely. I know I sound like a broken record, but that's the way it sticks in your head. Do not skip your payments. You will be charged interest on the outstanding balance, and then you'll also be charged late fees. Do not go over your credit limit. Exceeding that limit or getting close to it will damage your credit history and lower your score. Again, remember that 30%, the balance is owed. Avoid using cash advances. This is usually a very expensive source of funds because the interest rate applied to a cash advance will be considerably higher than the one that applies to your purchases. And avoid buying on impulse. Think about what it is you want to buy, the reasons why you need it, not want it. Okay. Now I'm going to discuss the payment trap. A lot of us have been in this payment trap before. How long will it take you to pay off a $3,000 debt at a 14% interest rate if you only pay, say, a $60 minimum payment? At that debt, that interest rate, the total interest would come up to $3,310. That's a lot. That's like double of what your limit is, okay? You also want to try and remember to keep your debt payments less than 10% of your income after taxes. If you take home $750 a month, spend no more than $75 a month on credit. So the key to credit card success is to not get trapped in the mindset of I'll buy now and pay later. When you do borrow, you want to ask yourself how and when you'll repay the debt and how much it will cost you. There are a lot of warning signs of too much debt. And the first one is you only make the minimum payment on your credit cards each month. The next is you have at least one credit card that is near, at, or over the credit limit. You are occasionally late in making payments on bills, credit cards, or other expenses. You use cash advances to pay other bills. You bounce checks or overdraw your bank accounts. You don't know how much total debt you have, and you don't have any savings. Again, I've been talking a lot about credit, and now I'm going to talk to you about the 5 C's of credit: capacity, character, collateral, condition, and credit history. So the first, capacity. How is your financial health? Can you repay the debt? Okay, lenders and business owners want to know how long have you been at your present job and what is your salary, how many dependents you have, how many other loan payments do you have, and what are your current debts. And they're also going to look at what is your debt to income ratio. The next is character. Do you intend to repay your debts? Have you ever used credit before? Do you pay your bills on time? And do you have a good credit report? That's how they check your character. The third is collateral. What are your resources for repaying the debt? Do you own any property? Do you have anything basically that they can take if you don't make your payments? A savings account? Do you have any investments that you can use as collateral? What is it that you have just in case you default on your payment? The next is condition. This considers the overall condition of the borrower, the lender, and the economy. There are instances when an institution is not issuing credit or making loans due to factors totally unrelated to you. And then lastly is credit history, and this is measured by your credit score. Again, it's a snapshot of a person's credit picture. This 3-digit number is a numeric value that's assigned based on a borrower's level of credit risk. Again, the higher the score, request for credit will more likely be approved at a lower interest rate. And credit scores change for good or bad over time depending on your credit history. So some common money issues. The source of most personal debt is spending more than you need. Don't go shopping when you're bored because you'll buy things you'll rarely use. If you're prone to impulse shopping, try to make a clear plan for what you need to buy and what you need to avoid. Stop trying to keep up with the Joneses. I know a lot of people suffer from FOMO, which is fear of missing out. If you really want something, you can come back the next day or even the day after. Be patient when it comes to shopping. A lot of big companies try many tricks to get us to buy goods we don't really need. For example, don't be swayed by 50% off sales promotions. Just because it's on sale doesn't mean it's a good value or that you need to buy it. I used to work in retail. I know this for real. Don't get excited over every 3 for the price of 2 or 3 for the price of 1. Otherwise, you'll just start to accumulate things you're never going to use. And if you feel pressured by a salesperson, walk out. If you really want the product, you can always come back. Is it true that in your 20s it can be difficult to save because you have student loans, etc. to pay off? And that saving will hopefully become easier later in life? Well, if you put it off for too long, you'll eventually find yourself in your 50s with no savings or no contingency plan. The earlier you start saving, the more productive it becomes. If you can get into a regular savings habit, it's easier to increase the monthly deposits as your financial situation improves. And then the last money issue is not following a budget. And I'll be getting into budgets in the next few slides. A lot of people say a budget is restraining and limits my freedom. But that's not true. It actually does the opposite. It puts you in control and helps you achieve your financial goals. Now, there are 4 steps to creating a successful budget. And the first is adding up all of your income. So list all sources of monthly income. And this is your net income, not your gross. So the money that you do have coming into the household, whether it's from a full-time job, part-time job, child support, rent, Social Security, etc. Add up all of your monthly income. The next is to add up all of your expenses. There are 3 different types of expenses. There are fixed expenses, flexible expenses, and discretionary expenses. Your fixed expenses remain the same every month. So that would be your rent or your mortgage, your car payment, and perhaps your car insurance. Those are things that you know how much they're going to be every month and they don't change. The next is flexible expenses. These are things that you need, but they range on a month-to-month basis. So your utilities, gas, groceries, etc. And lastly, there's discretionary expenses. Those are expenses that you want to do. Going to get your hair done, your nails done, signing up for Netflix, Hulu, etc. Things that you want to do, gym memberships, etc. So once you have all of your income added up and all of your expenses added up, you're going to subtract your expense total from your income total. You're either going to be in the black, which is the positive, or in the red, which is the negative. And that will take you to step 4. You need to prioritize. Where are you at? Is your expense total greater than your income total? If it is, you're in the negative, and you need to decide what steps you can take to either A, reduce your monthly expenses, or B, earn additional income. And you also have to prioritize your money. Think about what will positively affect your life in the next few years. A few reasons that personal budgets fail, again, first and foremost, is failure to prioritize your expenses. What's important? Your discretionary expenses are not as important as your fixed and your flexible. Failure to budget for practically normal out-of-pocket expenses like groceries and gas. Failure to plan for the unexpected. Failure to include quarterly or annual expenses. And lastly, spending more money than you earn. So you're budgeting for a specific reason, and that's to attain some type of goal. When you're setting your goals, they need to be realistic, obviously something that you can achieve, specific, it has to have a timestamp on it, so limited in time, and it has to be actionable, something that you know you can work towards. So you can't say, hey, I want to be a superhero next week. It has to be something that's realistic that you can actually get to. So you have your budget, you have your goal, you want to get your spending plan in place. And a spending plan can help you manage your money more effectively, live within your limits, reduce your reliance on consumer credit, and save for the things that you want. In order to know what you spend now, to get a clear picture of how you're spending your money, it may help to keep a spending diary for a month or two. And this means saving your receipts and writing down the items and the amounts for everything that you spend. And when it comes to spending, you have to do things step by step. So firstly, pay your monthly bills. Set aside the money you'll need for your weekly and day-to-day expenses. Put money into savings. Set aside money for larger expenses that you know are coming. And if you begin to earn more, increase the amount that you save as much as you can. Remember that savings is the key to success. Strive to put at least 10% of your weekly, bi-weekly, or monthly paycheck in the bank. Forego instant gratification for your long-term goals. I want to thank you all for joining me today. Hopefully, we'll all be living debt-free in 2018.